Hey, good evening, everyone. Welcome to another session of Paytm Money Express. And today we got two very interesting topic to discuss about. The name of the whole topic is Multi-Index Investing and Arbitrage Fund. The first topic is, of course, the Arbitrage Fund. And the second topic that we are going to discuss is Multi-Index Investing Fund. Now, before I start, very quickly, I would like to read the disclaimer for the event. Investment in securities market are subject to market risk. So read all the related documents carefully before investing. All presentations, discussions, content are purely educational in nature and are in no way an advice or recommendation. Representations are not indicative of future results. For all information, please visit www.paytmmoneywebsite.com. Right. I'm Neeraj Gogoi, your host. And just before quickly, what the Paytm Money Express is all about. So what we do here is that basically for new investors who have started investing and want to know about different concept of mutual fund. You talk about passive investing, active investing. You talk about ETFs and all different aspects. Large cap, small cap, mid cap investing. So we discuss basically here so that investors can really understand how he need to plan his investment. So today, the first topic, as I said, is arbitrage fund, and the speaker is Mr. Karthik Kumar. He's a fund manager for Axis Quant Fund, and he's with Axis since 2019. So before that, he was a portfolio manager with Silver Tree Investment Management, a Hong Kong-based company from 2017 to 2019. And before that, he was again with Asia Investment from 2007 onwards as a portfolio manager. So it's a great pleasure to have Karthik today. Karthik, welcome onto the stage.
Thanks a lot for having me, Neeraj.
Thank you. Great to see you.
Same here, pleasure's mine.
Yes, Karthik, we have been doing this program, quite regularly now. We are updating our viewers about the market so that, they basically understand what is happening. And of course, there are a bit volatility in last month. Now, today, we have seen a fantastic bounce back. Mid cap, banking, small cap, large cap, Nifty 50, all started, giving a fantastic rally. So now the most critical thing is next year is the election time. Volatility is expected. So as an investor, what kind of investment he should be, what should be his investment strategy, Karthik?
Okay. So firstly, I think if you look at the markets are more concerned about what the central banks, US central banks, and the central banks across the world are doing rather than our elections. Really,
Correct.
the focus on elections will only start post the state elections and depending how the results of the state elections pan out. But you are absolutely spot on in the sense that we will see heightened volatility in the markets, which is why I feel for somebody who's coming in new, it should not be somebody trying to make a quick buck in, let's say, 3-4 months. If you're coming at these levels in the market in an environment where there is macro uncertainty and there is election uncertainty, it is better if you come in the longer run, because in the longer run the markets don't care about elections. You can go and look back at how the market responded to coalition governments in the late 90s and also UPA government when it was formed. The markets initially had a bout of volatility and they corrected, but subsequently, given that India growth story is quite strong and relatively insulated from the party in power, so over time it kind of reverts back to that rewarding that story. So which is why I say look at a longer term and not just a shorter term to kind of make a quick buck.
Absolutely. Now, as you said, the wealth creation is always a long-term play. It's not a short-term play. And now coming to your topic of the day today, arbitrage fund, very interesting. Many of our viewers might not be knowing what arbitrage fund, how it works, what it's all about, what it is. So can you take us through the art and science of arbitrage fund and who should be investing here?
Okay, so I'll start with the first question as to what is an arbitrage fund and who should be investing here, and then we can look at into how is it that we manage the arbitrage fund, right? So arbitrage fund is a very low risk profile fund. It is
mm,
essentially used to park your money. So let's say
mm.
you've got some capital. Let's say you've got 100 rupees.
Okay.
You
Mm,
can look at it as an option between, let's say you want to put it in FDs, you
mm,
want to put it in a liquid fund, a money
mhm,
market fund, low duration
mm,
fund, an ultra short
mm,
fund. One of the options for you is an arbitrage fund.
mm,
So arbitrage funds typically don't take naked exposure to the markets. By
mm,
that I mean there is typically we don't just go long stocks, because when you
mm,
go long stocks, when you just buy stocks, you are obviously your payoff depends on if the stock is going to increase or decrease, right?
mm,
Here, what we do is we go long a stock and then we short the corresponding short the corresponding stock in the futures market.
mm,
And when we do that, there is typically a spread between
mm,
the price of a stock
mm,
in the in the cash market and the futures market, which is what
mm,
we intend to capture. For instance, I'll give you an example. Let's say
mm,
there is a stock trading at 100 rupees on the
mm,
cash market, and it is
mm,
trading at 101 rupee in the futures market. What
mm,
we do is we invest 100 rupees in the stock in the cash
mm,
market, and we short
mm,
an equivalent amount in the futures market. Now,
mm,
because and the futures typically the futures we trade is a 1 month expiry futures.
mm,
So when it comes to expiry at the end of the month, the prices of the stock and the future have to converge, because or else you can just take the deliverable in terms of
mm,
there is free money to be made, to put it shortly. If at the end
mm,
of the month, at the end of the contract, if the price of the future doesn't converge to the price of the stock, then there is
mm.
free money to be made. So which is why
Absolutely.
it does converge. And when it
Mm,
converges, we capture that 1 rupee spread in the example I gave you, right? Because I
mm, mm,
went along the stock at 100, shorted at 101, and the two should converge, which means that I would capture that 1 rupee spread. So as you can
mm,
see here, once you are long a stock and short the future, you don't care about whether the stock is going up or down, because typically the stock price and the future price move in tandem. What you
mm,
care about is the spread between the stock and the future price. And as I said,
mm,
at the end of the month, they typically tend to converge. They have to converge
mm,
for obvious reasons, which is why we capture the spread. So
mm,
essentially, this is quite a low risk product. So
mm,
this is a strategy which we call as an arbitrage strategy, because there is very little risk at play here. It's an arbitrage.
mm,
Arbitrage essentially means, in other words, to put it simply, there is money on the table. You just have to take it by putting the right set of trades in there, right? Um, so in an arbitrage fund, by definition, 65% of your book has to
mm,
be in these arbitrage trades, and the
mm,
other 35% can be in fixed income, or can be in debt instruments or debt
mm,
products. As
mm,
to why do we have this limitation of 65%? The
mm,
biggest attraction, or the biggest thing going for an arbitrage fund, is the fact that the taxation is very
mm,
similar. The taxation is same as an equity taxation. By that,
mm,
what I mean is, if you hold an arbitrage fund for short term, you'll be charged an short term capital tax gain at 15%.
mm,
If you hold it for long term, which is more than a year, then you get an
mm.
LTCG tax of around 10%. So, right,
Correct.
that is the biggest thing going for an arbitrage fund. Whereas if you look at corresponding debt funds that I mentioned, like liquid fund, ultra short money, low duration, money market, low duration funds, which are in the same
Mm,
space as arbitrage funds, the debt
mm,
funds get taxed in a very different way, and they
mm,
are taxed at higher interest rates for the first 3 years, which is at your marginal income tax rate, and then there is a long-term capital tax gain rate post the third year, which again is higher than your equity long-term tax rate.
mm,
So you clearly have a tax advantage, but to benefit from this tax advantage, you need to have at least 65% of the book in what I call as
mm,
arbitrage strategy, which I explained to you before, which
mm,
is you will basically go long a stock in cash
mm,
market, and you will short the corresponding stock in the
mm,
futures market to capture the difference. Now, I think it's fairly evident now that it's quite a low risk product. And as I
mm,
said, from a return perspective, the returns are very similar to what you would get out of the four categories I've mentioned: liquid
Hmm.
fund, ultra short, money market, or low duration. So these are
Hmm.
the these are the products that are in that ballpark, and which you would look at
Hmm.
as options within that category, and you may want to decide how you want to allocate. But as I said,
Hmm.
arbitrage funds, at the risk of repeating, have one distinct advantage, which is a tax advantage. Because even
Hmm.
if they give same level of returns as all the four category of funds that I mentioned before, net of
Hmm.
taxes, your return would be much higher in case of arbitrage fund as compared to some of the other four categories for the same level of return.
Hmm.
Now, the other advantage of this fund is the fees are typically low, and also
Hmm.
the exit load is low. Is You have an exit load, but it is for a period of only 1 month. Post that, there
Hmm.
is no exit load as well.
Hmm.
So,
Only for hmm. if you sell
sorry.
it off within 1 month.
Yeah, and even that is quite limited, right?
Hmm.
So, let's break this down. What is the variability? So all as I've laid out all the positive sides of it, right?
Hmm.
So what is the catch in this product now? So the
Hmm.
catch in this product here is, uh, I gave you an example saying I go
Hmm.
long a stock 100 and short the equivalent stock in the futures market at 101,
Hmm.
right? So the catch here is that 1 rupee is not set in stone. This month, the difference could be 1 rupee or 1%.
Hmm.
Next month, that difference can be zero point 0.5, which is
Hmm.
0.5%. And the third
Hmm.
month, it can be 0.75%. So the
Hmm.
variability or the risk is that you don't know what the spread in the market is going to be for your
Correct.
arbitrage strategies, and they typically
Hmm.
have a range. So over the last 6-7 months, they've hovered between a range of 0.6% to around 0.8%. So by
Hmm.
that, what I mean is, if the stock is trading at 100, the futures would typically trade from 100.6 to 100.8. So we are going
Hmm.
long stock at 100 and shorting the corresponding futures at 100.6 or 100.8, depending on the market levels. So obviously, if it is at 100.8, it is great to be in the product, because now you're capturing 0.8%.
Hmm.
Whereas if it gets lower, then you may want to look at alternate options. So that
Hmm.
is the variability in the product. So which brings me to the next important point: what should be the investment period in this product? The
Hmm.
investment, as I said, this is a product where you want to park your money, and park your money in a very tax efficient way. But because there is variability associated with these spreads, you want to park it at least for 6 months. You don't want
Hmm.
to come in for 1 or 2 months, because
Hmm.
in any particular month, the spread may not be predictable. But over a six
Hmm.
month period, or one could say with a fair level of probability or a fair level of risk assessment, that the spread should be commensurate for that period of investment.
Hmm.
So which is why I say the parking period should be at least 6 months, is in my that would be my sense from a conservative perspective.
Hmm. Okay. There are quite a few questions. In fact, you said simultaneously buying and selling in futures and buying in the stocks or vice versa. So you
Yeah.
might be taking lots of quant help, right? Automation and automated um, tech technology or something to do your transactions.
Yeah, so there are systems in place that will
Hmm.
help us kind of execute those kind of orders, where we don't take risk and we are kind of doing these things simultaneously. So there
Okay.
are systems in place that will help us do that. Yeah.
Do that. Okay. So there's a question from Mr. Vikram Prabhuji.
Mm.
Can we consider arbitrage fund to park emergency corpus?
Mm.
What are the parameters to choose
Mm.
while choosing an arbitrage fund? To consider to while choosing an arbitrage fund.
Okay. So, as I said, well, when you say park emergency corpus, it depends on as I said, the most important thing is what period you want to park it for. And I would still go back to my previous statement, which is, if
Hmm.
you park, then please park it for a period of at least 6 months.
6 months.
Anything short of that, you may encounter periods where the spreads may not be consistent. So I would
Hmm.
suggest at least come in for a period of 6 months. As to what parameters one would choose while getting into arbitrage funds, so to be very honest with you, the arbitrage fund it's a operationally intensive exercise. So if you
Hmm.
think about it, it is not about so the spread between stocks and futures is there for everybody to see.
mm,
Even Vikram, for instance, can go to an NSE website and pull up, let's
mm,
say, a particular stock's price and the corresponding futures price and see what the difference is, right?
mm,
So that is there for everyone to see. It is an operationally intensive process, and that is what differentiates the one fund from the other. So
mm,
typically, there are sub strategies that we can get into where some of these funds may be involved, maybe taking part in some of the sub strategies which slightly deviate from what I explained to you.
mm,
Uh, but largely the game is quite similar across the funds. So what one would want to see is a track record over a longer period of time, because that
mm,
serves, while there is always that disclaimer that past returns is not indicative of future returns, but at the end of the day
mm,
it gives you an idea of how it has been managed in the grand scheme of things.
mm,
And you can also look at the volatility of the fund. That should also give you an
mm.
idea of how it is managed, and you can compare it to peers. Those are the three parameters I would largely suggest looking at. They can serve as good guideposts in this process.
Mm. Okay. So while parking your money, we have got again, as you said, four alternatives as well, like
Hmm.
liquid, money market, and low duration. And so,
Correct.
so the only criteria is the tax advantage for the arbitrage fund that we should think about, and the time period.
So there is also a slight difference in returns. So if you
Hmm.
look at over the last 1 year, the arbitrage as a category has given better returns than some of the
Mm,
categories that you mentioned. So
mm,
obviously it will have its cycle. So it is not purely about taxation, but tax is a big component in factoring in making your decision.
mm,
So as I said, over the last 1 year, the returns have been slightly better, but net
mm.
of taxes, the returns are, the differential is much higher. So taxation will play an important role in kind of guiding you to that decision.
Okay. Now, another important thing is that as we approach the next year, election
Hmm.
year, volatility is going to increase.
Hmm.
Do volatility impact performance of arbitrage fund?
Yes,
The
they do.
gap
So
might be
for
more. Hmm.
Sorry, go ahead. Sorry,
Yeah,
please go
yeah.
ahead.
Go ahead. A gap might be more during the high volatility time.
Okay. So as I
Hmm.
said, what we do is we go long the stock in the cash market and short the futures, right? So
Hmm.
who's on the other side of the futures trade? The people on the other side of the futures trade is our HNIs and
Hmm.
typically FIIs are the typical people on the other side of the futures trade who are going long
Hmm.
the stock futures, right? So
Hmm.
what happens is during steady to upward markets, the spread remains quite consistent. The spread, when I say the spread, I mean I'm referring to the spread between the stock
Hmm.
price of the stock in the cash market versus the price of the stock in the futures market.
Hmm.
But when you see steep market corrections, and I emphasize the word steep because a
Hmm.
correction of 2 or 3% doesn't matter in the grand scheme of things. What I'm
Hmm.
emphasizing is steep correction. So something like a March of 2020, which was the
Hmm.
COVID period, or a
Hmm.
Feb leading up to it. So typically in those cases, what happens is HNIs and FIIs, they kind of close their book, or they bring down their book, and they bring down their exposure to the futures, long stock futures, in
Hmm.
which case the spreads in the market compress for us, where
Hmm.
again the spread between the stock and the price of the price in the futures market kind of compress. So if
Hmm.
the markets were to correct very sharply for any
Hmm.
particular month, you can get a case where the spreads can collapse significantly. Which
Hmm.
is why, again, I go back to my previous point. On a 1 month basis, I wouldn't use this. If it should, a holding period should be at least for 6 months. But having
Hmm.
said that, if you think about the Indian markets, at least the way I think about our markets, there is a structural positive story there, which means eventually these FIs, HNIs who are on the other side of my trade on the futures market should come back into these
Hmm.
markets, and subsequently that spread should come back again. So which is why I feel over a longer period of time you could get a 6 month period or a 8 month period is much better. But on
Hmm.
any particular 1 month, if the markets see a strong correction, you will see a
Hmm.
compression in that spread, which can impact the returns of the product.
Okay. Okay.
And case in
So
point, I would refer to months like March 2020 or February 20, March, April, March and April of 2020.
mhm. So, as an investor, when is should I allocate a certain percentage of my investment to arbitrage fund, or when I can use it as a tool, for example, as a tool for hedging against volatility? Now, if
Hmm.
I'm expecting volatility, so can I, I'm just thinking from investing perspective, say
Hmm.
for 10, 15, 20%,
Hmm.
I can park it in my arbitrage fund. Now,
Hmm.
election result could happen either way, right?
Yeah.
If the favorable result, it will rally probably,
Hmm.
and then I
Hmm.
can book profit on my existing portfolios. Now,
Hmm.
if there is not expected outcome, then there would
Hmm.
be a correction. I can use that fund for buying stocks at a lower price. uh,
That is a great idea because we still have around what 4 5 months to go for election and election results. So
Correct.
that would mean you are invested at least for the period that I think is the critical threshold period that you need to be invested in arbitrage funds for.
Hmm.
Plus, you get the tax benefit, and then you can use that cash to deploy very in a very flexible way in the market if you think the markets are getting to attractive levels. So I think
Okay.
that's a great way of looking at it. Yes.
It can be done. It can be
Yes.
done. Anything that you would like to, as your final advice, as a final suggestion with respect to arbitrage fund, your
Hmm.
final thoughts?
So I'd like to emphasize two or three things. First, you get a taxation that is the same as an equity product taxation, which is the
Hmm.
biggest advantage for this fund. But at the same
Hmm.
time, the risk level of this product is extremely low, where we take little to no exposure to markets, and we are always hedged. So in a
Hmm.
sense, the risk levels of this product is pretty low, and it presents a good opportunity. It's a good product to park your money in a tax efficient way compared to some of the other options available
Hmm.
in the markets currently. Those are the three things that I would like to leave the audience with.
Wonderful. Thank you, Kartik, so much for sharing your thoughts. In fact, many of our viewers, in fact, this is a little bit lesser known, I think, product. People know mid cap, large cap, small cap. People
Hmm.
know, other funds. But yes, I'm sure uh, people will find opportunity to use this particular product, as we said, as and when required, giving the situation arises. Right.
Absolutely. One can look at it on that last point. One can look at it as an option within. It is an equity product, but it is. You can look, as I said, you can compare it to other debt options available, which we talked about the four categories. One can look at
Mhm.
those as
Okay. Okay.
well. Options.
So thank you so much, Kartik. Looking forward to see you again here in this program, uh, and with some other product next time. And with that, like to thank you. Thank you.
Look forward to it. Thanks again for the opportunity. Thank you.
Thank you so much. Yeah.
Thank you.
Okay, guys. So that was Mr. Karthik Kumar from Axis Fund, and he was talking about Arbitrage Fund. Pretty interesting product, which can be used very effectively. So our next speaker is Mr. Vinod Bhat. Okay, so he is going to talk about multi-index investing. That is again a very interesting area, interesting topic. In fact, very lesser known. Okay, let me quickly introduce him. Mr. Vinod Bhat is a portfolio manager, an equity strategist at Aditya Birla AMC Limited. Vinod comes with an overall experience of 2 decades with close to 15 years in financial market and investment banking space. He has been associated with Aditya Birla since 2018. And prior to joining Aditya Birla, he was the Vice President, Corporate Strategy Business Development with Aditya Birla Management Corporation Private Limited. Previously, he was an investment banker at Credit Suisse and Ocean Park Advisors in the USA. So, Vinod, great to see you here today.
Yeah, hi Neeraj, thanks a lot. First of all, wish you all a very happy Diwali to you and all the audience here. And I hope this will be a productive session for everyone.
Yeah, absolutely, absolutely. And we are eagerly waiting for your this particular session, and we want to learn about multi-index investing. We have been talking about passive investing, investing, Nifty 50, Nifty Next 50, banking, all this sectorial thematic investment. Now, take us to what is multi-index investing, Mr. Vinod.
Yeah, so essentially, see, if we look at common investors like you, me, and the
Mm-hmm.
audience. What do we want from our investment? Everybody wants good returns, right? At least reasonable
Correct.
returns, right?
Mm-hmm.
And that's what most people end up focusing on. But then slightly savvy investors also understand that you need consistency of returns. It's not enough to get like plus 20% one year and minus 25% the next year, right? You'd rather
Mm-hmm.
prefer a plus 12.5, 13% every year, right?
Mm.
The third is the risk involved, right? Which is the loss of capital or the drawdown, right?
Mm-hmm.
So everybody thinks, okay, if I invest 100 rupees today, I want to double it next year, right? But
Mm.
sometimes it happens that it halves to 50, right? So you should be prepared for that. And lastly,
Mm.
we want the process to be convenient, we want it to be low cost, and we want it to be tax efficient, right? Now the problem is, if we look at the investment options, whether it's equity like stocks or equity mutual funds, or fixed income, which is largely fixed income mutual funds, or gold silver ETFs, or even REITs in which most investors, either they are doing their job or they're doing their business or whatever, and they don't have time to track the markets, right? So they
Mm-hmm.
don't know how much to allocate to these asset classes, right? When to allocate. In each asset class, there are so many schemes, mutual funds available, stocks available, bonds available, which ones to allocate, right? When to
Mm.
enter, when to exit, how to keep the cost low, how to keep the tax low, right? And so what happens is, in the end, they just end up, becoming a victim to either greed, which is FOMO,
Mm.
fear of missing out, or panic,
Mm.
right? Which is staying out of the market completely, or selling in a panic when the market undergoes a downturn, right? So if you look at multi-index fund of funds as a solution, it provides an answer to all these problems that are faced by
Mm.
common investors, right? So an
Mm.
investor can just invest in this one multi-index fund of fund, and within that fund of fund, they get exposure to four asset classes: domestic equity,
Mm.
international equity, fixed income, and commodities. Right? There
Mm.
is a dedicated portfolio manager who manages this multi-index fund of funds. So he takes care of the allocation to the asset classes and the rebalancing, right? And because
Mm.
these asset classes are negatively correlated, what it means is, if equities does well, maybe it overcomes the fact that gold is not doing well, or vice versa, right? So the overall
Mm.
portfolio return is much more stable. So the risk-adjusted return, we say, is better, right? So
Mm.
in a nutshell, this provides a solution to an investor's needs of reasonable returns,
Mm.
low risk,
Mm.
consistent returns, tax efficiency, and low cost.
Mm. Yeah. Okay. So okay, that is how now what is the ideal weightage of different sectors, different you sort talked about domestic, international, you talk
Right.
about fixed income, you talked about commodities, gold and all. What is the distribution of weightage in different categories?
Yeah, so the typically the way it works, and I'll explain our process, how we do it as an illustration, as an example, so everybody
Right.
understands, right?
Mm-hmm.
So what we have as a mandate for the our multi-index fund of fund,
Mm-hmm.
the domestic equity category can have an exposure between 20 to 80%. Okay, international equity can have 0 to 20%. Fixed
Mm-hmm.
income, I think, is between 15 to 75%, and
Mm-hmm.
commodities is again 0 to 20%. Right. So the key
Mm-hmm.
question, like you mentioned, is how do we decide how much to allocate to each asset class, and then select the funds and ETFs under that. Right. So we have a two-step process for that. So one is, we have a proprietary model that we run that looks at various
Mm-hmm.
metrics like valuation metrics,
Mm-hmm.
momentum related metrics, volatility related metrics, economy related metrics, and it gives a recommendation, right? So, for example, as of Monday, right, our model was suggesting that we
Mm-hmm.
should have around 50 to 55% allocation to equities, okay,
Mm-hmm.
around 10 to 12% allocation to commodities, which is gold, silver, ETFs,
Mm-hmm.
and the remaining to fixed income, right?
Mm-hmm.
Uh, and now, for example, the news came yesterday that US inflation is lower than expected. So suddenly the US yield has gone down, markets have rallied, right? So the momentum is positive, right? So
Mm-hmm.
if I run my model today at the end of day, it will show me that, okay, you can increase the equity allocation slightly, right? So this
Mm-hmm.
uh, allocation is dynamically kind of, the
Mm-hmm.
recommendation is rebalanced, right? And then the
Mm-hmm.
second step is the fund manager. So decision. So I am the fund manager for our multi-index fund of fund. So then I take a call whether we should, for example, increase equity allocation, or just stay put for now, and take a call at a later time, right? So that is how kind of we decide on the overall equity allocation, how much to the overall asset allocation in terms of how much to allocate to each asset class.
Hmm. How dynamic it is? Is it done fortnightly, monthly, or daily? How
Right.
dynamically you keep on allocating?
Yeah. So see, we can run the model every day, right? So at the end
Hmm.
of day, right, and it will give us a signal. But
Hmm.
then the signals will be very volatile, right? Like one day it will say increase equity allocation, second day it will say reduce equity allocation. So the
Hmm.
way we have built our model is that we have put an additional threshold that once it reaches that threshold, then it gives a proper rebalancing signal, right? So
Okay.
we wait till we get that rebalancing signal.
Right.
So just to avoid unnecessary churn, right? Because
Hmm.
in this multi-index fund of fund, we are investing in index ETFs, for example, right? Nifty ETF, Next 50 ETF. We are investing in mid-cap,
Hmm.
small-cap index funds or momentum ETF or some sectoral
Hmm.
ETFs. Uh, Same thing, a gold silver ETF for fixed income, right? So we don't want to keep on churning because that is a transaction cost, right?
Hmm.
So we wait till that a model reaches that threshold and gives us a rebalancing signal. Now, when it may give us a signal that is we can't predict, right? So that depends
Hmm.
on those parameters, like I mentioned.
Hmm. And now, historically, if we look at the performance,
Yeah.
how has been the performance in last 1 year, 3 year, 5 years kind of horizon?
Yeah.
For
So our the multi-index fund of fund was launched around a year back.
hmm.
So the 1 year performance, the return is around 14.5%.
Hmm.
And it has beaten its benchmark. It has also beaten the category average, the multi-index fund of fund category average.
Hmm.
And that's and one of I mean the main reason I think is because the model we are using, we have good confidence now. We have
Hmm.
back tested it over the past 20 years data, and we have been rebalancing based on that model for the past 1 year,
Hmm.
and we kind of managed to get things right. So around 14.5-15% is the 1 year return.
Hmm. Okay. So one question,
Mm.
we talked about, of course, what are the benefits? What are the challenges and the risk associated with investing? Right, exploration of potential drawbacks, drawdowns, drawbacks, including complexities, tracking errors,
Right.
possibility of underperformance.
Correct. So first thing to understand is, the multi-index fund of fund is an asset allocation product, right? So, like I said,
Hmm.
it gives you exposure to 4 different asset classes, and because
Hmm.
these are negatively correlated, typically, one asset class when it is doing well, some other asset class will not be doing well, right? And that's how
Hmm.
over time you get that stable risk-adjusted return, right?
Hmm.
So, the first drawback is if we are in an environment where equity markets are rallying, right?
Hmm.
Then typically just the Nifty index, because it's
Hmm.
100% equity, right? That will do better. And the multi-index fund of fund will underperform, right?
Hmm.
But where does such a asset allocation fund of fund show its magic is when there is a downturn in markets, right? So, for example,
Okay.
if there is the COVID pandemic when market crashed, right? Or
Hmm.
suddenly there's some geopolitical tension like we saw in the Middle East, right? Or
Hmm.
let's say hypothetically, if inflation reading shoots up and there's a signal that Fed may raise rates and so on, right? So
Hmm.
any time when the equity markets correct, that is when you will see that the multi-index FOF will outperform, right? But typically that's what that's the first thing to keep in mind, right? Uh, the second, of course, when we invest, the underlying, like I mentioned, for example, in our multi-index fund of fund on the equity side, we invest not only in Birla ETFs and index funds, but in external, all the fund houses, whichever best ones we can identify, right? So we try to identify the ETFs based on largely, two key metrics. One is the tracking error, and the second is the expense ratio, right? So we want to keep both of them low, right? So, for example, there are a number of Nifty 50 ETFs in the market,
Hmm.
right? So we select the best one based on the tracking error and the expense ratio. Same
Hmm.
thing, we have invested, for example, in the Kotak Nifty 50 ETF, right?
Hmm.
But for example, for the next 50 ETF, we have invested in a different fund house, right? For the mid cap index fund, small cap index fund, we have invested in Birla products and
Hmm.
like that, right? So we identify the underlying ETFs, index funds, based on the metrics like I mentioned. Now, it may happen like, historical data may not match reality
Mm-hmm.
going forward, right? So just because the tracking error is low earlier, historically, it doesn't mean that it will continue to be low going forward. So that is something we have to keep on looking at. We monitor on a regular basis.
Mm-hmm.
The third, of course, is on the tax front, right? So there is an advantage as well as a disadvantage with fund of funds, all fund of funds that investors should understand. Now, what is the biggest advantage? If an
Mm-hmm.
investor makes changes to their portfolio on their own, right? So for example, let's say an investor has invested in a Nifty 50 ETF, and now suddenly markets, mid caps and small caps start rallying, so they sell some portion of their holding in the Nifty 50 ETF and they buy mid cap small cap fund. Then
Mm-hmm.
you have to pay capital gains tax, right? If you have made any profits on your Nifty ETF, right? But the advantage in the multi-index fund of fund is any churn that we do,
Mm-hmm.
there is no tax implication for the investor as long as we are
Mm-hmm.
doing it within the fund of fund. So that is the biggest advantage. So you save
Correct.
a lot of tax on the churning, which if you do on your own, you'll have to keep
Mm.
on paying tax on every transaction, right? On every sell order that you give if you make a profit.
Mm.
The drawback here is, like you all know, uh, from April 1st, 2023, the taxation rules were changed, right? So all debt, mutual funds, commodity ETFs, international funds, and all FOFs, including multi-index FOFs, they are now taxed at the marginal rate of tax, and there is no indexation benefit. Earlier, we used to have those benefits. So if you held
Correct.
a FOF for 3 years, then it would come close to equity taxation. But now that advantage is not there, right? So that is something to keep in mind.
Okay. There are quite a few questions for you. Aman Kumar Agarwal, he's asking, can you please share some differences between multi-index fund of fund and multi-asset fund of fund and multi-index fund?
Right. Yeah. Yeah. That's a good question. Thanks, Aman. So, see, if you look at the multi-asset fund, and many have been launched over the past year from most of the fund houses. So they also provide exposure to these different asset classes, right? Domestic equity, international equity, fixed income, commodities, and so on, right? The difference is that the multi-asset fund invests in underlying stocks and bonds, right? And commodity ETFs, right? So it does not invest in ETFs and index funds. It invests in stocks and bonds, individual stocks and bonds.
Hmm.
Whereas the multi-index fund of fund, it invests in underlying ETFs and index funds. So that is an important distinction. Let me repeat again why it is
Hmm.
important. Because see, when the fund manager of a multi-asset fund has to make an investment, he needs to figure out, not only how the market environment is, what is the trend, uh, not only which sectors, they should play, which themes they should play, but then also identify the individual stocks they want to invest in, right? Take positions in those stocks, and anytime they want to exit any stock, buy another stock, there is a transaction cost involved, right? There is a lot of work that goes in, right? Whereas in a multi-index fund of fund, because I'm investing in an ETF or
Hmm.
an index fund, it's very easy for me, right? So
Hmm.
the way I have to do it is, like, for example, let's say I had invested in a IT ETF, information technology ETF earlier, or a pharma ETF earlier, right? Because I thought, okay, these sectors will do well. And once I thought that, okay, they are done with their rally, I could easily exit the ETF because I
Hmm.
just had to place one sell order. There is no
Hmm.
liquidity issue, right? You don't have to depend really on some broker trying to match orders and make sure that the price is not impacted and so on, right? So it's very efficient in that manner that we can make changes in the portfolio very quickly and very easily, because we are just buying and selling ETFs and index funds, and we don't have to put in the lot of work to identify stocks, look at whether they're liquid or not, and if I want to buy a stock, whether it's available at the price and so on.
Hmm. Okay. There's a question from Mr. Rohan Iyer. Does ABSL Multi-Index invest in ABSL ETF and index funds, or open to invest in any AMC? I think you have answered that.
But
You
yeah,
can again go
I
ahead.
just repeat, just for clarification, the ABSL multi-index fund of fund, it's a diversified fund of fund, so it invests across the industry, ETFs and index funds. So it does not invest only in Birla products. So that is a big
Okay.
advantage, like I said, because it widens our field of play, right? So, And then we look at all the ETFs in the industry. Like I mentioned, we look at the tracking error, we look at the expense ratio, and try to select the best ones for the multi-index fund of fund.
Okay. So there's a question from Mr. Nirmal Gore. How does international limit affects portfolio management and investment in multi-index fund?
Yeah. So, as you know, RBI has placed restrictions both at the fund house level as well as the industry level, right?
Industry level.
Yeah, for international investments. And that does come into play typically for international funds because the industry has already reached that limit, right? Uh, but as far as international ETFs are concerned, so for example, if let's say Aditya Birla multi-index fund of fund, in that I want to invest in the Nasdaq ETF or the S&P 500 ETF or an emerging market ETF, we still have room available because the industry is not close to that limit of $1 billion for overall, right? So we do have some room available, and we can invest in that if we want to.
Okay. So there's a question from Mr. Vikram Prabhu.
Yeah.
What is the approximate total expense ratio of multi-index funds can one expect, including fund expenses, relevant ETF expenses, etc.?
Yeah. So again, that's a very good question because that is one of the big advantages of the multi-index fund of fund compared to other asset allocation fund of funds and funds, right? Because there is a SEBI mandate that the TER that we can charge on any fund of fund, uh, basically you have to calculate the weighted average TER based on the underlying investments, and there is a cap which is like double the underlying TER, right? So the advantage, like I mentioned, is that in the Birla multi-index fund of funds, we select the ETFs and index funds based on their TER and the tracking error. So we try to make sure that the weighted average TER of the underlying ETFs and funds is low, and so the TER of the multi-index fund of funds, essentially, if you see, it will be just around 1% kind of a thing, because most of the ETFs that we invest in, typically you will see it will be 0.5% or plus or minus of that, right? So it kind of averages out, and typically the weighted average of the underlying is around 0.5, and we can charge double of that.
Okay. So again, Vikram Prabhuji, there's another question from him. What is the investment philosophy of ABSL AMC? And this multi-index fund follows growth-oriented or value-oriented style of investment?
Yeah. So, see, what we do is, like I said, we use our proprietary model to decide the overall asset allocation, how much to allocate to different asset classes, right? But then it comes to the question that is asked, so how do we select the underlying ETFs and funds, right? So let's say, first decision is how much to invest in a large cap, like a Nifty or a next 50 ETF versus a mid cap and a small cap index fund, right? So, what we have seen in the market is there has already been a rally in mid caps and small caps. Large caps have underperformed, right? So, what we did was we reduced part of the mid cap, small cap allocation and increased the large cap allocation, right? Because we believe that the returns going forward in the near term can be better for large caps because the valuation is quite reasonable, right? Second decision is, if we look at the sectoral thematic ETFs, index funds that are available, which one should we invest in, right? Or even the smart beta ETFs, right? So, for example, right now we are staying away from global related thematic ETFs. So we have not invested in the IT ETF or the pharma ETF and so on, right? We would prefer to invest in domestic focused index funds or ETFs, or for example, a momentum ETF and so on, right? So, from a philosophy point of view, we have that flexibility that we are not tied to growth or value or any particular style in the fund of fund. Like I mentioned, it's very diversified, it's very flexible, and based on the market condition. Like, for example, let's say today, the situation is, like I said, in the US, inflation seems to be going down. So it's like interest rate cycle has peaked. The 10-year yield has fallen below 4.5%. So growth stocks have started doing well. We saw yesterday Nasdaq in the US went up more, 2.3%, right? So going forward, if next year, our belief is that we will be in an environment where the first half of the year, maybe interest rates will remain at current levels, but then the second half, we should start seeing some rate cuts at some point in time. So if that happens, then growth style will start doing well. So then we will start, investing in growth-oriented ETFs and index funds in the multi-index FOF.
Okay. So Vinodji, again, your question, like everybody wants to know, we also ask all our fund managers your views on the market as an investment, for 2024. How do you think it is going to unfold? How
Yeah.
market and giving so much of factors coming in, so much of events coming up.
Correct. So, if you see the last few months, markets have been very volatile, right? So, there were concerns about the Fed rate hikes. There were concerns about a recession happening in US and other developed markets next year. The Chinese economy is not doing too well. And then, we had these geopolitical tensions in the Middle East. US interest rates were quite high, dollar was strong and all, right? So, those were all global macro concerns. They were impacting all the emerging markets, right? But fortunately for us, kind of India has been shielded from all these, largely from all these global macro concerns, because we are a more domestic demand-driven economy, and most of the high-frequency data indicators that we track, or even if we see on the ground, we see that our economy is doing quite well, right? From a growth point of view, GDP growth rates are being upgraded. Uh, Current account deficit is in control, forex reserves are good, fiscal deficit in control, right? So overall, India as an economy is doing quite well. Earnings growth is quite good, right? And that is a reason why we have seen that markets have been in a consolidation range, right? So if you see year to date, our Nifty 50 index is up about 8-9%, right? So which is what our expectation was in when we published our annual outlook in December last year. We said our expectation is 8 to 10% return this calendar year, which is in line with what is happening, right? But next year, what is our outlook, right? So next year, because interest rates initially will be on the higher side, uh, there will be some slowdown in growth in the US and other developed markets, right? Uh, but we expect Indian economy to do better compared to the other regions. So whether it's US, Europe, China, some of the other Southeast Asian nations, our economy should do better. Our GDP growth is expected to be 6.5 to 7% real GDP growth, right? Earnings growth for the next 2-3 years expected to be around 15% or more, right? So if that is the case, and like I said, valuations, especially for large caps, are quite reasonable, just near the 10-year average, right? So and if it looks like Fed has reached the peak of the interest rate cycle, and sometime next year they will start reducing rates, then it will be positive for equity markets, right? So, so we are getting more positive on our outlook on Indian equity market, and we think, next year is likely to be good for Indian equities. But more than that, right? As equity investors, we have to keep a horizon of 3 to 5 years at least. Ideally, at least 7 years, right? Because like if you see predictions for the next 7 years, India is expected to be like the third largest economy, right, from the fifth largest right now, and that will translate into good earnings growth and so on, right? Uh, so next year, like I said, we are becoming positive on our outlook. We think growth will be good, macro concerns will reduce, as things will start looking better, especially for India. Earnings growth will be good, and hence we expect returns, equity returns also to start doing well. So most probably, like I said, in our multi-index fund of fund also, our model has started showing, okay, we can start increasing the equity allocation.
I think it was a great pleasure talking to you, Vinodji. Thank you so much. I'm sure our viewers today, we have learned two very important concept. One is, of course, arbitrage fund, how it works, how much, when it should be used as a tool. And second, we have spoken about multi-asset and multi-index fund investing. Thank you so much, Vinodji, for being a part of this program.
I just like to add one last point.
Yes.
Yeah, so I just want to give some examples to kind of make some points more concrete fashion, right? So even though I am in the investments field, right, in my own family, when I looked at what my close family members, relative friends were doing, like there were people who have still kept their savings only in FDs, right, or in gold, or they're only investing in real estate. On the other side, I have some relatives who started just investing in direct stocks, and then they moved on, and then they are doing direct, FNO trades right now. And earlier,
Mm,
people were speculating on Bitcoin and so on, right? Uh, so that was quite frustrating for me. So just wanted to let the viewers know that I have recently published a book by Penguin called the Financial Independence Marathon. It's available on Amazon, and I've tried to
mm,
explain some of the concepts, like whatever I talked about in the past 20 minutes, in terms of asset allocation, how to think about different asset classes, how to, you can select underlying funds, how you can rebalance your portfolio. And
mm.
I've written it more in a form of a story to keep it interesting, so that even my own family, friends, relatives would understand it. So you can definitely take a look. The book name again is the Financial Independence Marathon.
Lovely. And I'm sure we are going to have a program specifically on this particular book.
Sure.
What the things that you have shared, and you have to take us through the whole journey, all the concepts, wisdoms that you have shared. I'm sure
Sure.
for new investors as well as old experienced investors, it's going to be very, 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 very useful. And
Thank
thank you
you.
so
Yes.
much. And thanks all the viewers. Have a great Diwali, great New Year. Looking forward to see you again in our next program. Thank you so much, viewers. Thank you so much, sir. Thank you.
Thank you. Thank you. Good luck. Happy Diwali.
Bye.
Thanks.
Yeah.
Bye.
Thanks.